Okay, let's unpack this. Have you felt the hum, that undeniable buzz around one company that seems to be right at the absolute epicenter of the AI revolution?
Oh, yeah. You can't miss it. Nvidia.
Exactly. Nvidia. Their name just everywhere, isn't it? Tied directly to, well, the future of computing, it feels like.
It really does.
Right. And today we are taking a deep dive. We've got a stack of sources here all about Nvidia Corporation, that's ticker symbol NVDA, and, what the future might hold for this absolute powerhouse.
And these sources, they cover a lot of ground. Detailed company analysis, financials, and some really fascinating insights from a quantitative intelligence perspective, too.
Yeah, that quant stuff looks interesting. So our mission here really is to help you cut through all the noise. We want to unpack what makes Nvidia so dominant.
But also look straight at the challenges because, let's be honest, there are big ones.
Definitely. And see how some of these advanced analytical models are viewing its performance, its potential. What are the key nuggets you really need to know about NVDA right now?
Okay, let's do it. Where do we start? The beginning.
Yeah, let's jump in there. NVIDIA wasn't always this AI titan. Founded way back 1993. And for a long time, people knew them for GPUs, graphics processing units, mostly for gaming.
Your GeForce cards, right.
Yeah.
Powering PC games for years. They were pioneers in high-performance graphics.
But the real shift, the moment that kind of set the stage for where they are now, that was CUDA, wasn't it? Back in 2006.
That was arguably it. The key turning point. CUDA.
Okay, CUD comes up constantly. Break that down for us. What is it?
So CUDA stands for Compute Unified Device Architecture. Before CUD came along, GPUs were pretty much stuck doing graphics tasks, rendering pixels.
Right.
CUDA was this parallel computing platform and programming model. It basically unlocked the power of those GPUs for general purpose computing. Developers could suddenly program these massively parallel chips for all sorts of stuff beyond graphics.
Ah, okay. So it wasn't just the hardware. It was the software key that let developers actually use the hardware in totally new ways.
Precisely. And NVIDIA didn't just drop the key. They kept walking through that door. Through the 2010s, they made a really strategic shift towards data centers, scientific research, and crucially, AI development. It turned out that the way GPUs process things in parallel, absolutely perfect for deep learning.
Which was just starting to explode then.
Exactly. By around 2016, as the AI boom really started picking up speed, NVIDIA GPUs basically became the standard, the default choice for training AI models.
Wow. So from gaming graphics cards to basically being the essential plumbing for artificial intelligence, that's quite a pivot.
Huge transformation. And today, they are the dominant force. AI, accelerated computing, their GPUs, the CUDA platform, they're critical enablers for this whole AI revolution we're living through.
Let's talk more about that plumbing then, their products, the ecosystem around them. What's the core tech?
Well, it still starts with the GPU, the graphics processing unit, but they've specialized it for different markets now. You still got gaming, GeForce, professional visualization, think NVIDIA RTX or Quadro for engineers, designers, and automotive, their drive platform for self-driving tech.
But the segment everyone's watching, the one driving that crazy growth we hear about, that's data center, right?
Absolutely, no question. The data center segment is the giant. Chips like the H100, the newer B200, the Grace Hopper Superchip. This is their largest and fastest growing area by a mile.
And these are built specifically for
the massive number crunching needed for AI. Training these huge models, running inference, that's when the AI actually uses the model and high-performance computing, like scientific simulations.
And the secret sauce, you called CUDA a moat earlier. That's the big advantage.
It's a huge moat. Yeah, CUDA is that software foundation. It lets developers easily tap into the power of NVIDIA GPUs. There's this vast ecosystem now, libraries, tools, frameworks, and importantly, tons of developers who know how to use it.
So competitors can't just build a faster chip.
It's much harder than that. Building a comparable software stack, fostering that developer community, that takes years, maybe decades, and just enormous investment. It's not just about silicon, it's the whole software ecosystem that makes NVIDIA so sticky for AI work.
Gotcha. And beyond the GPUs and CUDA, are they building out other pieces too, like a wider platform?
They are. You've got NVIDIA AI Enterprise, which is software for businesses doing AI. Omniverse, that's their platform for 3D simulation and collaboration, things like digital twins, industrial metaverse applications.
Right.
Their networking side, which got a huge boost when they bought Mellanox back in 2020, That's critical because you need super fast connections to link thousands of these GPUs together in AI supercomputers.
Makes sense. Can't have bottlenecks.
Exactly. And they also have things like the Jetson platform for robotics and AI at the edge, outside the data center.
So it's really a full stack they're offering. Hardware, software, networking, all optimized for accelerated computing.
That's the strategy, the whole platform.
Okay, so who's buying all this stuff? Who are the customers driving this incredible demand? And what's it done to their financials?
The customer base is pretty diverse now, but the really big ones, the ones buying at incredible scale right now, are the hyperscalers.
The cloud giants.
Yep. Amazon's AWS, Microsoft Azure, Google Cloud, Meta. They're building the massive infrastructure needed for cloud AI services, and they are buying Nvidia's data center GPUs in, enormous quantities, truckloads of them.
Building the AI factories, essentially.
That's a good way to put it. But Nvidia also sells to large enterprises, setting up their own AI capabilities, research labs, universities, plus the original gamers, professional workstation users, automakers, even governments.
And this demand, you said explosive growth earlier, that feels like an understatement, looking at the numbers.
It really is. Unprecedented is the word, especially kicking off late 2023, almost entirely driven by that data center AI demand.
The revenue figures are just mind-boggling.
Tens of billions per quarter, consistently setting new records. And it's not just the top line, their profitability is phenomenal too.
Those high-end chips must have great margins.
Especially the data center ones, yeah. Consistently seeing gross margins in the mid to high 70% range. That reflects the performance, the specialization, the whole package.
Wow.
And because of operating leverage, their net income, their actual profit, has often grown even faster than revenue. They're generating just massive amounts of free cash flow.
Which lets them plow money back into R&D acquisitions.
Exactly. Keep funding the innovation. Stay ahead.
Management keeps giving strong forward guidance too, which fuels the optimism.
Yeah.
But you do have to wonder, can this growth rate possibly continue? It's so extreme right now.
That is the trillion-dollar question, isn't it? Or maybe the $3 trillion question now. This pace is tied to this massive initial build-out of AI infrastructure. AI isn't going away, obviously, but the rate of that build-out, the spending growth, could it slow down? That's what everyone's trying to figure out.
Okay, so incredible dominance, off-the-charts growth. But who's trying to challenge them? What's the competition look like? Because they can't be completely alone.
In that top-tier AI GPU space, right now, NVIDIA's performance and market share are pretty much unrivaled.
Pretty much. So there are contenders.
Oh, definitely. You've got direct GPU rivals. AMD is probably the most direct competitor with their Instinct MI series chips for AI. The sources say they're making inroads, gaining some traction, but still much smaller share than NVIDIA in high-end AI.
Okay, AMD. Who else?
Intel is also in the game with their Gaudi accelerators. They're pushing hard, too.
And then there's that other angle. Their biggest customers potentially becoming competitors. The hyperscalers themselves.
That's a really important dynamic to watch. A potential long-term strategic threat. You have Google developing their own tensor processing units, TPUs, for years now. Amazon has their Inferentia chips for inference and Trainium for training. Microsoft is also developing custom silicon.
Why are they doing that? Just cost.
Cost is part of it, sure. But it's also about control, reducing reliance on a single supplier like NVIDIA, and maybe optimizing chips exactly for their specific cloud workloads and software stacks. It's like, instead of buying a powerful general engine, they want to build their own custom-designed engine for their specific race car.
Does the analysis suggest this is an immediate danger to NVIDIA sales to them?
The sources seem to frame it more as a gradual, long-term trend. Building these super complex AI chips and integrating them across massive global cloud infrastructure, that takes a huge amount of time and resources. It's not like they'll flip a switch tomorrow and stop buying NVIDIA entirely, more like a slow shift over years.
Okay, so established rivals like AMD and Intel, and the looming potential of in-house chips from the cloud giants. What else? Startups?
Yes. There's a whole ecosystem of AI chip startups doing really interesting, sometimes very specialized things. Our sources mention quite a few.
Like who?
You've got Cerebras Systems. They make those huge wafer-scale chips, the WSC, like a chip the size of a dinner plate, basically, for massive AI models. Grok is getting a lot of buzz. They make LPUs, language processing units, and they claim super fast speeds for inference, especially for large language models like chatbots.
So, faster responses.
That's the claim, faster inference. Then there's Samba Nova with their reconfigurable data flow approach. Tenstorrent, led by the famous chip designer Jim Keller, working on ML processors. GraphCore has IPUs, intelligence processing units, others too, like D-Matrix, Rebellions in Korea, etched focusing on specific types of AI models. Extropic is even exploring using thermodynamics, like heat flow, for computing. It's wild.
So a lot of different approaches, maybe targeting niches Nvidia isn't focused on or trying to leapfrog them in specific areas.
Exactly. They're offering innovation, sometimes specialization, pushing boundaries. It's a really dynamic field.
Crowded and dynamic indeed. And we haven't even mentioned China yet.
Right. Competitors within China are a factor too. Huawei, for instance, has their Ascend series, like the 910, building domestic alternatives to Nvidia.
Which brings us neatly, or maybe uncomfortably, to geopolitical risks. That seems like a huge cloud hanging over Nvidia.
It's definitely a major headwind flagged in the sources. The tensions between the U.S. and China, specifically the U.S. export controls on the most advanced AI chips, think H100, A100, directly impact Nvidia's business in China, which was a significant market.
And those rules can change, right? Get tighter.
They can, and they have. It creates uncertainty. These are government policies, and Nvidia just has to comply.
How are they handling it? I heard they made special chips for China.
They did. To navigate the restrictions, they developed compliant chips. The sources mention the H20, L20, and L2. These are specifically designed to be less powerful, falling below the performance threshold set by the U.S. export rules.
So they can still sell something in China?
Yes, but they're less capable than the chips sold elsewhere, which puts them in a tougher spot competitively inside China.
Competing against Huawei's best domestic chips with essentially nerfed versions of their own?
Precisely. They face strong competition from Huawei and others who are pushing hard to develop domestic alternatives, often with government support or preference. So there's a clear risk of losing revenue share in China. Plus, the risk that restrictions could tighten further. And China's whole push for tech self-sufficiency is fundamentally aimed at reducing reliance on companies like Nvidia in the long run.
So it's not just lost sales now, it's potentially losing a massive market over time.
That's the long-term concern highlighted. Add broader geopolitical uncertainty impacting supply chains, market access. It's a complex layer of risk on top of everything else.
Wow, okay. So let's recap the picture. Incredible market dominance, growth that's just off the charts, but also serious competition brewed from rivals, huge customers, nimble startups. That's a major geopolitical overhang affecting a key market. How on earth has the stock market processed all this complexity? NVDA, the stock.
Well, the stock performance has been extraordinary, simply extraordinary. Looking at the data provided, up to around June 12, 2025, the price was hovering around $125.10. But get this, the 52-week range was $35 to $127.50.
35 to over 127. That's almost parabolic.
It really has been. That surge pushed its market cap to around $3.1 trillion. Puts it right up there with the absolute largest companies in the world.
Now, that surge is purely the AI hype.
It's driven by that exponential demand for their AI chips, definitely. The market is pricing in enormous future growth. But here's the thing. Despite its massive size, NVDA is still a highly volatile stock.
Because it's so tied to that growth story continuum.
Exactly. Its valuation is sky high, trading at a significant premium. Many argue it's justified by the growth and dominance, but also means the stock is incredibly sensitive. Any hint of a slowdown, any whiff of increased risk can cause pretty big swings.
High valuation, high growth expectations, high volatility.
Got it.
What about the people steering this ship? Management.
NVIDIA's leadership, especially co-founder and CEO Jensen Huang, gets a lot of credit. Widely seen as visionary. Making that big bet on GPUs for general computing with seed way before the AI boom really hit, that foresight gave them this incredible head start.
And their execution seems strong too, keeping up with demand.
Generally, yes. Their relentless innovation, pumping out new, more powerful chip architectures, building that CUDA ecosystem, and somehow managing to scale production to meet this absolutely insane demand, those are definite strengths highlighted in the analysis.
But challenges for management too, surely, beyond the external competition and geopolitics.
Absolutely. Just maintaining that dominance requires constant, massive investment in R&D to stay ahead of everyone. Managing the complex supply chain is another huge challenge, especially for things like advanced packaging. CAWS is the term you hear that's needed to build these complex AI accelerators. Any bottleneck there can impact supply.
CAWS, chip on wafer on substrate, snacking the chips.
Right. Essential for performance. And then there's managing expectations. When your stock is priced for perfection, any slight miss on guidance, any sign the market might be getting saturated, even temporarily, that can hit the stock hard. Keeping investors happy is a constant balancing act.
Okay, so with all this going on, the crazy growth, the intense competition, the risks, the high valuation, how do these sophisticated quantitative models try to make sense of a stock like NVDA?
This is where that quantitative intelligence perspective gets really interesting. We have this chart analysis here labeled NVDA performance with alpha intelligence MV1.5 ATS R1B7. It gives a fascinating glimpse into how advanced quant models analyzed NVDA's performance over a specific period mid-July 2024 to early June 2025.
Right, I see the chart. It's comparing 3 different approaches over that time.
Exactly. The top part shows the cumulative return, the ROI, for 3 strategies. First, a pure algorithmic intelligence model. Let's call it the AI model.
Right.
Second, a machine learning layer built on top, adding intelligent risk mitigation, the ML model. And third, just a simple buy and hold strategy.
And the difference is, wow, buy and hold returned about 18% over that period, which isn't terrible, but...
But look at the other 2. The core AI model, an impressive 167.11% return.
Whoa.
And the ML model, the one with that extra risk management layer, still achieved a massive 158.64% return.
Okay, so both quant models absolutely crushed buy and hold. More than 8 times the return in this period.
That's the headline takeaway. Significant alpha generation, as the source calls it. These models demonstrated an ability to potentially extract much more value from NVDA's movements than just passively holding.
Why did the ML model do slightly less than the pure AI one? You mentioned risk mitigation.
Yeah, the analysis suggests that's the key difference. That intelligent risk mitigation feature in the ML layer is designed to protect capital, especially important with a volatile stock like NVDA. So it might take fewer aggressive bets or maybe exit positions slightly earlier if risk signals spike, compared to the pure algorithmic model, which might ride out more turbulence.
So it potentially sacrifices a little bit of the very top-end return for smoother sailing and better downside protection.
That seems to be the idea presented, a trade-off. Enhanced capital protection might mean capturing slightly less of the absolute peak upside, but still delivering vastly superior returns to buy and hold in this example, with potentially less stress along the way, providing that intelligent risk mitigation benefit.
Okay, that makes sense. Better protection, maybe slightly less peak return, but both massively outperformed just holding. What's the middle pane showing?
That just breaks down the performance period by period. You can see the incremental gains, how each model performed in different shorter windows within that overall time frame. It gives you a sense of the consistency or lack thereof.
And the bottom pane, that looks like the price chart with signals.
Right. The white line is NVDA's price, clearly showing that strong climb from around $100 to over $150 during this period. The bars are trading volume, color-coded. Green is volume on days the model generated a buy signal, vol at buy. Red is volume on sell signal days, vol at sell. And gray is other volume.
And the little white triangles are the buy and sell signals themselves. Up for buy, down for sell.
Exactly. Overlaid on the price chart.
And looking at it, the signals seem to kind of line up with the swings. Buy signals near dips or breakouts. Sell signals near peaks.
That's what's interesting. The analysis suggests the alpha Q model is dynamically adapting. Buy signals often appear near those temporary lows or when the price breaks upwards strongly, often accompanied by significant green vol at buy bars, suggesting the model sees accumulation or renewed buying interest.
Okay.
Conversely, sell signals tend to pop up near price peaks or just before the stock pulls back, maybe when momentum seems to be fading or red vol at sell, volume increases. It suggests the model is trying to intelligently capture gains and reduce exposure before downturns.
So it's not just holding on for dear life. It's actively trading based on its interpretation of the data, price action, volume, momentum.
That's the picture painted here. An intelligent adaptation to market sentiment and dynamics, aiming to navigate the volatility much more actively than just buying and holding. It really does present an impressive image of how sophisticated quantitative intelligence might tackle a complex, high-flying stock like NVDA.
This level of analysis, this alpha Q intelligence, it sounds pretty advanced. Who is it for?
Well, according to the source material, AlphaQ is specifically designed with professional fund investors and quant experts in mind. People who can really dig into that detailed algorithmic and machine learning-driven analysis and signals.
Okay. But the source also mentioned something called Lay's Q. What's that?
Right. Lay's Q is positioned differently. It's designed more for ordinary investors. The idea is to take the core concepts of quantitative intelligence, like the insights from these models, but present them in an easier-to-understand format. And crucially, it heavily emphasizes that intelligent risk mitigation component.
for peace of mind investing, as they put it.
That's the phrase used in the source, yes. So trying to make the power of QI accessible, but with a strong focus on managing risk for individual investors who might not be quants themselves.
Interesting. So Alpha Q for the pros, needing the deep dive data, Lays Q for individuals wanting the QI insights with built-in risk management.
That's the distinction laid out in the material we looked at.
So let's pull this all together. Why does this deep dive into NVIDIA, its business, its risks, and how models like Alpha Q analyze it? What does it matter to you, the listener?
Well, first, understanding NVIDIA's core business is just fundamental now. Its central role in AI, that CUDA moat, the incredible financials, you need that baseline. But just as importantly, you have to grasp the competitive landscape. It's not just AMD and Intel anymore.
Right, those hyperscalers developing their own chips are a huge long-term factor to watch, and that whole swarm of innovative startups pushing in different directions.
Exactly. And then layering on those significant geopolitical risks, especially around China, the export controls, the domestic competition rising there. The sources make it clear that's a major variable.
It's definitely not a simple story of up and to the right forever.
Not at all. It's complex, dynamic, and that's where seeing how something like the Alpha Q model analyzes the stock becomes really insightful. It demonstrates the potential of using sophisticated quantitative approaches to try and navigate this kind of high growth, high volatility environment.
It shows how these models aim to generate returns that significantly beat simple strategies, like buy and hold in this case, while also actively trying to manage the inherent risks, especially with that ML layer involved.
It gives you a different perspective, right? A data-driven lens on the forces acting on the stock, looking beyond just the headlines or the hype. It shows that even during a massive technological shift and a huge stock run-up, intelligent strategies focused on alpha generation and risk mitigation could offer real advantages in navigating the inevitable ups and downs.
Okay, so let's leave you with a final thought, something to chew on. Think about the incredible speed of this AI infrastructure build-out happening globally right now.
It's truly staggering.
Will that demand for cutting-edge chips like NVIDIA's continue at the same breakneck pace indefinitely? Or are we going to see a transition maybe from a frantic build-out phase to more of a, maintenance and optimization phase?
And how much will those in-house chips from Amazon, Google, Microsoft actually dent NVIDIA's dominance with those key customers over the next, say, 3 to 5 years? And what about the innovations from Grok, Cerebras, and all those other startups? Could one of them find a real edge?
And maybe the biggest unknown, how could geopolitics, particularly the whole U.S.-China dynamic, fundamentally reshape this entire market? Could regulations change drastically? Could supply chains be rerouted? How does the kind of quantitative analysis shown by models like AlphaQ help investors even begin to grapple with these huge, complex, forward-looking questions that go way beyond just looking at past results?
Those are the big, complex factors. They'll shape not just NVIDIA's future, but probably the next phase of the entire AI industry.
A lot to think about indeed. We've done the deep dive. Now it's your turn to process these nuggets of knowledge.